Mayo is badass. Stock market is gangster. Take what's yours and fuck the other guy, right?
When I hear people talking about the stock market, what comes to mind are usually images of making tons of money, working in fancy buildings, day trading, stress loads that can kill, and let's just say consumption. As of 2024, the global stock market has a value of $115 trillion. No, not millions or billions, trillions. Who, what, when, why, where, and how does a market like this exist? And most importantly, how do people make money off of it? So before we start looking into how people make money from the stock market, I want to first figure out what exactly the stock market is. When you hear people talk about buying or selling shares, stock, they mean that they are buying or selling pieces of ownership in a business. Through buying and selling these shares, many individuals and organizations have become beyond wealthy, with the clearest example of successful investing in the stock market being Warren Buffett, who has a net worth of $146 billion. Okay. Easy now, you can do up your belt buckle and not get too excited, because Mr. Buffett is in the top 1% of the top 1% of investors. Like, this guy is just different. Apparently, he is already filing taxes at 13. When I was 13, it was during the peak of the game Call of Duty Black Ops 3, and my biggest concern was getting 4 friends together to beat the Shadows of Evil Easter egg. Sadly, I could only ever find one other person to play with me, leaving that Easter egg unfinished and a permanent stain on my pride. So just keep in mind that the best investors out there have been doing this for a very long time and are incredibly knowledgeable and experienced in this field. The chances of you blindly walking into the stock market with zero understanding and treating it like a big game of roulette will unfortunately only end in tears. But don't lose hope. It is still more than possible to make incredibly good money investing in the stock market. All it requires is some know-how, discipline, and patience. It is good to know that there is a difference between a stock market and a stock exchange. A stock market will be an entire country's activity of buying and selling stocks. A stock exchange is a central physical or digital location within that country that allows for the buying and selling of shares. That is why in countries like the United States, you'll hear about the 2 big stock exchanges, NASDAQ and the New York Stock Exchange. A country isn't necessarily limited to only having one stock exchange, but it will only have one stock market. Cool. We now know that a share is a piece of ownership in a business, and to buy or sell these shares, you will use a stock exchange. But what's the point? Why do we as investors get out of the stock market? Well, a big reason why investors will buy stock is because of appreciation. As an example, you find a manufacturing company and are impressed by its profitability so far, so you decide to buy a single share. At the time of buying the share, it was worth $5, but you believe this company will become even more profitable in the future. After buying this share, the company managed to make more sales, bring down their costs, and improve their overall efficiency. The combination of these factors leads to the company making more profits, which means your prediction was correct. Because the company is even more profitable now, that means the value of your share has increased or appreciated. In this scenario, your share goes from being worth $5 to $10. If you decided to sell at this point, you would make $10 in revenue and $5 in profit. This profit you make is called capital gains. If the opposite was to happen and the company made less profit or no profit at all, the share would decrease. If you decided to sell your share and you make a loss on it, this is called capital loss. Making capital gains isn't the only reason investors like to buy shares. There are also dividends to think about. When buying shares of a certain company, they will make regular payments out of their profits to you, which gives investors a stable income. Not all companies will offer dividends, so if that is a priority for you, please first do your research to see which companies do offer dividends. I'm not going to tell you how to invest or into what in this video, but I would just like to say that making your sole investing strategy revolve around the idea of buying low and selling high is not in your best interest. Unfortunately, investing in the stock market isn't as easy as this. When deciding on what stock to buy, please first do your research and a thorough analysis of the financial side of the company, as well as the overall demand for the stock. In most cases, if the price of a company's shares dropped substantially, it has probably dropped this low for good reason, and it is not a reliable indication of potential stock growth. When a business's share price goes down, it can be because of multiple different reasons. But I would consider to be the major driving forces behind the movement of share prices have to do with supply and demand. A business will only be able to sell to the public so many shares as there is a limit. If more people want to buy these shares, the pool of available shares will shrink. Because of this decreasing availability, the price of remaining shares will naturally begin to increase, and with demand being high, investors will be willing to pay these increased prices. If you like what you have been hearing so far, and are thinking of getting yourself some shares, you should know that as an investor, you have two choices of stock: common stock and preferred stock. Common stock is what most investors will be buying or selling, as its value can be appreciated and sold to generate capital gains. Common stock is also cool because it gives you the ability to influence business decisions and policy changes. So the more common stock you own in a company, the more control you will have over it. Your other option is buying preferred stock. If earning a fixed regular income from your investments is more your style, then preferred shares are what you are looking for. When you buy a preferred share, it will come with a maturity date, and you'll be able to redeem its value upon reaching this date. These shares will experience far less volatility compared to common shares, making them much safer but also far more limited in their ability to appreciate. The last big difference is that with preferred stock, you won't have any voting rights or influence over business decisions. That's alright though, because we are here for the dividends. So let's say you buy a preferred share at $100 with 5% annual dividends, with a maturity date of 5 years. What this means is at the end of each year for the next 5 years, you will earn an additional $5. At the end of those 5 years, you can redeem your share, earning you $100. But in total, you would have made $125. Once that share has reached its maturity date, it's finished. Finito. That share no longer exists. Not all companies will have preferred shares or even offer dividends, so keep this in mind when choosing companies to invest in. Now we know the two kinds of shares investors can buy or sell, but we still don't really understand why companies make these shares available in the first place. For companies to be able to make purchases, pay for expenses, and invest in expansion projects, they need money, otherwise called capital. There's the more traditional route companies can take, which is approaching a bank to acquire a loan. There's nothing wrong with bank loans, don't get me wrong. They can be a real lifesaver. However, making shares available to the public allows companies to raise far more capital while keeping their debt to a minimum. There is a process a company will have to undergo if they wish to go public. This process is called making an initial public offering, or an IPO. The real tricky part of an IPO isn't the listing part. The hard part is determining the value of the company. You will need to know the value of your company, as it will be used as a metric when deciding on how many shares to issue and at what price. If you're ever curious about what investment bankers do, this is it. Well, part of it anyway. Many companies struggle with properly valuing their business and setting share prices, so investment bankers will be called in to help advise. For example, a company will want to go public. They call their investment bankers and conclude that this business has a value of $100 million. The company then issues 1 million shares at $10 a share. This allows the company to raise significant capital while keeping its debt low, which is just not achievable using traditional options like bank loans. Issuing, buying, and selling stocks has some great benefits for both investors and businesses. Investors can accumulate wealth, and businesses can accumulate capital. It's a win win situation. But where does the stock market actually come from? Surely it wasn't just willed into existence by the gods of capitalism. Surprisingly, the stock market goes back quite a distance in history, starting in 1300s Venice. During this period, there wasn't an official stock market or any kind of stock trading at all. What was being traded was debt, and lots of it. It would be common to find individuals roaming Venice, offering people loans for their businesses or day-to-day expenses. These loans would come with terms and agreements for interest rates, as well as the date at which they must be paid back. After issuing these loans, or debt, money lenders would approach investors to sell them the debt. If the investor bought the debt, they would receive the interest on the debt from the original borrower. These money lenders can be thought of as history's earliest example of brokers. The first real stock exchange in history was in 1600s Amsterdam. During the early days of the stock exchange, your options were pretty limited to just the Dutch East India Company, as it was the only publicly listed company. Eventually, they would allow other companies to list on this exchange, but for a while, it was just the Dutch East India Company. When purchasing shares in the Dutch East India Company, you would be investing in a voyage a ship was going to take, and to reduce the risk of significant loss of investments, investors would often finance multiple different voyages. If you're okay with all the not-so-woke practices this company took part in, you would be looking at receiving dividends in the range of 12 to 40%, which is pretty damn good. It was also during this period that Europe experienced its first market crash, all thanks to tulip flowers. Back in these days, owning some tulips was like owning every designer brand all at once. It was the peak of luxury and wealth. It got so out of control that people were borrowing money based on their ability to sell tulips. It is believed that the straw that finally broke the camel's back was a shipment of tulips on a Dutch East India Company ship that completely flooded the market and caused the tulip bubble to burst. This event is often called tulip mania. In 1792, the first official stock exchange was created, the New York Stock Exchange. This early version of the New York Stock Exchange came about due to 24 merchants and brokers coming together to sign the Buttonwood Agreement. This agreement created an official location for companies to list their company shares for people to trade and would pave the way for modern-day Wall Street. Time moved on, and more stock exchanges started to emerge around the globe. But the next key event in the timeline has to be the Wall Street crash in 1929. This crash came after the Roaring Twenties and was the first and largest official stock market crash. What happened is that overwhelming optimism invaded the market, with people excessively overvaluing stock and buying far more stock on lines of credit than they could afford. All of this overzealous speculation and dramatic increases in stock prices led to a very sudden and sharp drop in the stock market. The fall-off from this crash was so large that the period from 1929 to 1941 was named the Great Depression. From 1971 to 2000, we saw the introduction of the Nasdaq, the Shanghai Exchange, Euronext Exchange, making the stock markets accessible on a global scale. In the early days of stock markets and exchanges, it was a pretty lawless place, due to many governments thinking investing in stocks was just a form of gambling with extra steps. It is no longer the case. Now the vast majority of exchanges and markets are heavily regulated and monitored to ensure there is fairness and security. Each country will have their governing bodies watching over its stock market, but the main country we will be focusing on is the United States. In the US, the big three to watch out for are the Securities and Exchange Commission, the Federal Deposit Insurance Corporation, and the Consumer Financial Protection Bureau. These are the guys responsible for creating and implementing rules in the market to ensure fair trading and that no one is abusing the system. You also find self-regulatory organizations that are not linked to governments, but have been given permission to regulate their members. These self-regulating organizations can be the exchanges themselves, or organizations such as the Financial Industry Regulatory Authority. Please note, these are the governing bodies for the US stock market. It will be different in each country. In South Africa, for example, the big exchange is the JSE. The JSE needs to ensure that they are in line with the rules of the Financial Matter Act, and the group that will be monitoring the adherence is the Financial Sector Conduct Authority and the South African Reserve Bank. Unless you're abusing the system somehow, you will for the most part not be interacting with these regulatory bodies too much. It is so important to stay in the loop with understanding who controls the stock market. It will help you remain up to date with any changes in policies or regulations which could affect your investments. With this all said and done, the stock market is a great place to build wealth and become more financially stable. It's just important that you approach it with the right mindset and understand this is no get-rich-quick scheme. In fact, the most successful stock market investors have all built their immense wealth and success off of disciplined, long-term investing. One of the greatest investors to ever live was Benjamin Graham, who is often thought to be the father of security analysis and value investing. His philosophy around investing was that as an investor, what you earn from your investment should always be greater than the price you had originally paid for it. He would go out of his way to find businesses that had solid balance sheets with minimal debt, above average profits, and a healthy cash flow. Graham became so knowledgeable in the world of investing that he released a book in 1949 called The Intelligent Investor. This book provided such powerful insight into investing, it might as well be your Bible for investments. In 2020, this book ranked 89 in Amazon's top 100 best-selling books. This just shows the staying power and reliability of Graham's work. Another successful investor you have more than likely heard of is the legend Warren Buffett. Funnily enough, Warren Buffett came across The Intelligent Investor when he was 20, and claims the book changed his life. I think it's safe to say it did, because as of recording this video, Mr. Buffett's investment company, Berkshire Hathaway, just reached a market capitalization of $1 trillion. If he had invested just $10,000 into Berkshire Hathaway in 1965, today that investment would be worth $60 million. I mean, just look at their stock price graph. It just doesn't stop climbing higher and higher, continuously outperforming the market. Warren Buffett was able to achieve this because 1. He's built different, and 2. He stayed true to Graham's teachings of remaining disciplined and patient with his investments. I hope my explanation of the stock market has been helpful and possibly inspired you to give it a crack. Just please, do not go into the stock market thinking you're untouchable and swinging blindly. Don't be afraid to look at a company's available accounting records. The good stuff is usually there. If you approach the stock market with a serious and disciplined mindset, your chances of success are already greatly improved. There's also no shame in admitting that you are lost and need some help. The internet has tons of free and paid educational resources that can greatly enhance your understanding of the stock market and investing. There are also tons of incredibly helpful investment advisors out there, more than willing to help. For a fee, of course. Honestly, I'd rather pay extra to have the help of a professional than let the market take me for a ride. That is the stock market in a nutshell. I hope you enjoyed it and learned something new. Enjoy the rest of your day.